Good morning, everybody. Hope everyone's doing well. Thank you for continuing to jump on our calls, and hopefully you can continue to finding some value out of these, and we will continue to try to provide some value. So we appreciate your time, and this one I think will have a little bit maybe more good news than some in the past. Although it seems like recently we've had a lot more and more to report that's certainly positive. So that's very good. But let's kind of just jump on in and get started. Today I'm going to talk about some of the major developments that have happened in the economy, in the stock market, and just overall in the last week or so. Since the very beginning of this, Melissa and I have really tried to focus a lot of these calls on specific data and information that we feel is key to trying to really get an understanding of what's going on. When I was preparing for this call this morning, I started looking back at a lot of the notes that we have had from previous calls going all the way back to the winter time. And it's just been really kind of interesting to take a look back, especially how things have transpired. And I don't know what it is about the last week, but we really feel that it's been a significant turning point in the data and in the information for the benefit. And all throughout this, we've kind of been really trying to identify what these significant data points are, either negative, and we've seen a lot of those, but also positive. And I want to talk a little bit about what those look like and what we think that means. But it's just been very interesting to look back and see kind of what assumptions were made, not only by us, but from various economists, about various data points along the way, and then what really actually transpired. And then kind of on a funny note, what the media said about them, because it was very interesting to see how we responded, how various economists responded, and then how the media responded. And I don't mean necessarily about the virus per se, or how to handle or deal with the virus, but more about economic pieces of information and the impacts of those and what they mean. But it's been an interesting journey. Melissa and I were talking about it the other day, and it's been interesting to see this and how it compared to 2008. And although they're significantly different, they had a lot of similarities, and it's been a very unique and interesting experience to compare two very, very major financial periods of time and of turmoil and how they looked. And we learned a lot. And I think as time goes by, because there will always be another recession, there will always be another financial problem in the world at some point. I think the more we have a deep understanding of how these events happen and how to deal with them before, during, and after, we can continue to make ourselves more and more prepared to handle future events as well. So where are we, and what's going on right now? Well, last week, despite protests, both peaceful and violent, the stock market had a pretty significant rally. I think there was a lot of question over the weekend how the market would react to a lot of the protesting and the looting, and it seemed to turn to pretty much an entire blind eye. Last week, the Dow was up almost 7%, S&P was up almost 5%, and to start this week, although I think we started down today, the markets have continued to really put on a pretty impressive show here. Where are we year to date? Well, the S&P is just almost flat. We're down about 0.75 of a percentage point on the S&P. The Dow year to date is down about 5%, and the Nasdaq surprisingly is up over 11%. and that's year to date from the highs, from the kind of the pre-coronavirus highs. The Dow's still down about 8% from the high, which was basically an all-time high. Nasdaq's about flat, and the S&P's down about 5.5%. So year to date, we've seen a nice kind of reset from the all-time lows, and even from or year to date, I should say, and even from the all-time lows. And we'll talk a little bit about that. But I'm sure you all as clients are aware of that when you log on your accounts or get your monthly or quarterly statements. I'm sure you've noticed that as well. So it's certainly a good thing. So it's kind of funny because it was either yesterday or the day before, but I'm on looking at Yahoo Finance, which comes up on my computer kind of automatically when I turn on my browser, and there was a huge, big, bold typing or a picture with a title, a heading, and it says, "The U.S. economy is officially in recession." The NBER said the COVID-19 crisis has launched the U.S. economy into a recession, ending the longest economic expansion on record. That's the title, and that's the headline on Yahoo Finance, and blast to millions and millions and millions of people of all financial and investing experience, of all demographics. That's what they see. Then you look right above, and if you're familiar with Yahoo Finance, they show the major indices and what they're doing for the day, but always right above their main headline. So what's above the headline? Well, the Dow Jones is up 300 points at 1.1%. The Nasdaq is up 71 points at 0.73%, and the S&P is up 23 points at 0.74%. And I just had to laugh because I see this mind-boggling headline, which I guess maybe it's not mind-boggling. Everybody knows that the word recession is very common right now, and there's certainly a lot of news about being in a recession, and maybe it's not a surprise, but it was important enough for Yahoo Finance to throw it right on that front page. But I just had to laugh because as I'm reading it, I'm watching the Dow Jones rally 300 points, and it just made me laugh. But it just goes to show how various certain parts of information don't always tell you the true story. And we talked about this a while ago on one of these calls. We talked about how bear markets work and historically how they have looked, kind of the how far they typically dip, how long they typically last, and some of the kind of pieces that tend to resemble each other in various bear markets that have happened over the course of time. And in particular recessions, it's very common that when a recession is officially called, you're usually on the other side and moving towards sunlight. Because by the time that data comes in, you already kind of know you're in a recession, but until it's official, when that data comes in, typically the markets start to pick up and react before a recession ends. It's usually actually a couple months before a recession ends. And then the recession starts to diminish. So it doesn't surprise me that we would see stock markets rallying in a recession, but I just thought it was kind of funny because it really just doesn't give the whole picture. So what's going on? Well, the recession actually started in March. It's just, at least with what Yahoo Finance is saying, didn't get called until this week, but that's 3 months behind. It was the sharpest downturn since the Great Depression, but as it turns out, it will likely be the shortest. As a typical recession typically lasts, I think it's like 15 or so months. This one is certainly looking to not be nearly as long. Friday's unemployment rate, or I should say Friday's employment report, should leave very little doubt that the U.S. economy has already hit the bottom and is starting to recover. And we've kind of talked about whether or not we feel that we were at the bottom back in March. I think it was like March 23rd or March 24th, where the the Dow and the S&P were at the bottom. We had an economist on not too long after that where, we asked, do we think we'll test new lows? And there was still a lot of question whether or not that would be the case. But since then, we feel pretty confident. And of course, we do not have a crystal ball. And of course, nobody knows for sure. But we feel very confident that we are not in a position at this juncture, based on this information and based on kind of where things look like they're headed, to test new lows. Every economist, I think, that's brave enough to make public forecastings through these payroll reports, and they all pretty much thought that they were going to continue to drop in May and that the unemployment rate would continue to rise. And instead, it was the opposite. Payroll rose 2.5 million and the unemployment rate dropped to 13.3%. And this was very, very, very surprising news to pretty much everybody. And as I kind of just mentioned, most economists were not ready to predict such a dramatic turn. It doesn't mean the U.S. is fully recovered or even close. I think it's very likely that a full recovery is going to take at least a few years, especially on the unemployment side. But looking for more positive numbers from here on out, I think, is very reasonable to assume. I guess it's only fair to say, with regards to the unemployment numbers and the payroll numbers, there has been some articles and some questioning whether or not those numbers are quote unquote cooked. Obviously, I don't have an answer for that. I guess in this day and age, anything is possible. That being said, I think if you really start to look at where these numbers come from, they come from the Bureau of Labor Statistics. They have over 2,000 career staffers who work in that organization, and virtually none of them are appointed by political people. And they really have very little ability to, quote unquote, cook the books. It just doesn't seem to make sense that, there's been questions. Did the Trump administration try to get these numbers to look different? I think when you look at who's actually putting out these numbers, I think it's very unlikely. I think the odds of a conspiracy is very low, probably zero. Where I think maybe this came from, and some analysts have kind of shed a little bit more light on this, is that this was a very unique period looking at unemployment, because normally what they do is they take these surveys and they poll a group of people to determine whether or not they have been working or not. But there were a lot of people who weren't necessarily working but were still on payroll, especially because of the PPP money, from the Payroll Protection Program, where employers were shut down. They didn't necessarily technically lay their employees off, but they were still getting paid. And that's really the gray area that maybe skewed the numbers. It's hard to say whether it is actually skewing, because it's just a very different example of kind of, are you unemployed? If you're still getting paid by your employer, you're not on unemployment, but you're not working. That being said, if you go back and you count those workers as unemployed, it would have put the jobless rate at 16.3% in May versus the official 13.3%. And that's kind of where a lot of the criticism came. Oh, the numbers are cooked. It should actually be 16 instead of 13. Maybe that's true. I don't think it's because the books were cooked necessarily. I very much think it's because of this very gray area and how a lot of employees were polled. However, if you go back and you use that same method for April and you bring those employees onto unemployment, April would have meant that the jobless rate would have been reported at 19.5% instead of the official estimate at 14.7%, which means that the drop in jobless rates in May would have been 3.2 percentage points, which is 19.5 to 16.3, not the 1.4 points reported on Friday. So it's still going down no matter what. No matter how you look at it, unemployment's gone down. And that change in the unemployment rate is what matters for the financial markets, not necessarily the percent from where to where. It's just that it had a change, and now it's very clear to see. Meanwhile, initial jobless claims also fell for the 9th consecutive week, and continuing claims remain below the peak hit, which was back in May. And both are consistent with an economy that's already hit rock bottom. And that's big news. And I think it was very surprising, in fact, to a lot of people how quickly, when the lockdowns looked like they were going to be prolonged, and in a lot of cases they were. I think a lot of the economists really started to get concerned about how quickly businesses would come back. And this information shows that they're starting to come back faster than before, than possibly expected. Another supporting piece of evidence that goes along with this, I talked about this weeks ago, is if you look at tax receipts from the Treasury. Basically, they pull how much has been withheld from W-2 payroll. You have to compare this to a similar period of time that has the same weeks because of how months and weeks get chopped off. And if you remember, if you were on one of the other calls, you got to use 2015 to make those comparisons. To make a long story short, it's all good news. Payroll tax receipts are increasing. They're up, and they're up from prior periods, and they're up from the lows. So all, again, very good news that signals that the acceleration of the economy has turned a corner. What does all of this mean for the stock markets? It's tough to say, but I think it's certainly extremely good news, and I think it very much sets a tone that although we certainly will see volatility, there's no question about that, it doesn't appear to be a situation that would rewind back to March levels of any sort. A while back, we made some outlooks about a month ago that the S&P would likely recover to the 3,100 range by year end. That's what a lot of the economists were kind of projecting about a month ago. We're just above 3,200 now. So we've already started to significantly move faster than I think a lot of analysts have expected. And we do continue to expect to see more recovery. Maybe not necessarily the magnitude in the straight line that we had from March levels, but I don't think it's unreasonable to see an S&P end in the 3,350, 3,400 range, and the Dow over 28,000 relative to this data and this information. And Dow right now is just a hair over 27,000. So, I think that that's certainly a possibility, and we're starting to get a lot of analysts and a lot of economists to back that up and support that with their numbers as well. We know profits are going to be down substantially in the second quarter. That's not even a question. But we believe that they should recover strongly several quarters thereafter. And meanwhile, the money supply is growing rapidly, and the Federal Reserve is prepared to keep the monetary policy loose for the foreseeable future. We're going to see continued rock bottom low interest rates, and there doesn't seem to be any question that that's going to be prolonged and continued for some time, likely until we see unemployment back to pre-COVID-19 numbers, which could be a couple years. The U.S. has just gone through such a tremendous turmoil so far for this year, and with the response to COVID-19 that included just unprecedented, widespread government-mandated economic shutdowns, and then all of a sudden, we had all of these, legitimate protests and riots and looting. It's been a wild 2020, and I don't think many of us who You would have asked in 2019 what this would look like if we would have expected to have any, any or all or any of these just really, really strange and very impactful situations. And nobody knows for sure what the second half of 2020 will bring either, much less 21 and beyond. But we think that, like in the past, those who have faith in the markets and in the future, and those who continue to have faith in the markets in the future will be rewarded. And emotionally, it's tough. And us as financial advisors and us as your financial advisors, we get it. We understand and we can appreciate it. A lot of emotions and a lot of stress and a lot of struggles in February and in March, just watching how fast and how strongly those markets dropped. It shakes you to the bone. But as we've always and always will try to counsel our clients, it's really more removing yourself from the emotions and making smart and wise financial decisions based on data, based on historical situations, and having a little bit of trust and understanding of how these bear markets work. And I think the good news is, looking back on this one, almost every single client of Stein Wealth really did a good job hanging in there. And like I said before, we're not 100% out of the woods. We still certainly expect some volatility, could even be a fair amount of volatility, and we don't necessarily see a full economic recovery for quite some time. But I think that there's enough information out there to say, although Yahoo Finance posts that we're officially in a recession, that it's likely that recession is over. And with that comes a whole new opportunity to reevaluate our perspective for, in particular for the accounts that we manage for you. And Melissa and I are in the process of doing that right now, as we will continue to for the future as well. So I think that's probably the best news we could have seen come this past week, and it's a big deal. It really is, and hopefully we start to see more and more reinforcement of that over the next couple of weeks. I made the analogy a couple weeks ago, maybe 2 weeks ago, that I thought the economy right at that point felt a lot like spring, where the trees were bare, but you're starting to see some buds. And I think with this information, in particular, payroll information, unemployment information, tax receipts, I think those buds are starting to open, and now we're starting to see some flowers blossom. There's still going to be some nights where it frosts overnight. That's not a question, and it happens in the spring. But I think we're really working towards getting to those summer days, and we're going to have some setbacks. There's no question about that. And who knows what's next? We got murder hornets and all sorts of other crazy things that are going to throw the news into turmoil. And don't always believe what you see on the media, because they do a great job of posting headlines like we're in a recession, but they do a terrible job of telling you what that actually means. And that's also why I think it's nice to have this time with you all, and for us to try to help you see a little more clearly what's important and what's not important and what you should be focusing on. So I think we'll leave it at that. Thank you all for your time. I will just pop it off mute here if anybody does have any specific questions. 1 second. Anybody out there have any questions in particular? All right, well, thank you all. Just on a side note, Stein Wealth office is 100% open now. We did, I believe, send out a survey, or we will be sending out a survey kind of asking for some of your opinions about how you'd like to have your various review meetings and things like that. We would like to get a general pulse of how our clients would like to do that. Although the office is 100% open right now, we're still doing a lot, if not most things, virtual with clients. But at some point, those things will change, and we would like your feedback to get an understanding of when and how you'd like to see that happen. Because at the end of the day, we want you to feel great about everything you're doing with us, and we will accommodate you no matter what. So thank you all for your time, and we look forward to talking with you soon. Everybody take care.